So we're looking at adding probably a minimum of $900 once gold breaks 3,440, which is not too far above the current level. Once it breaks up above that, we could run another $900 to 4,400-ish, let's say, in a similar space of time that the move in took, which takes us to that level at the end of this year. With that sort of trouble in store, I can see gold going up to $4,500 quite easily by the end of this year.
The United States has imposed tariffs on 1 kilogram and 100-ounce gold bar imports, according to a July 31st letter from Customs and Border Protection reported by the Financial Times. The new classification subjects these gold products to tariff levels, potentially disrupting trade flows from Switzerland, the world's primary gold refining center. This policy shift comes as technical analysts identify promising price patterns in gold markets. Alasdair Macleod of Macleod Finance notes that gold is completing a pennant formation based on Edwards and McGee's Dow theory framework. His analysis suggests a breakout above $3,440 could add roughly $900 to gold's price, targeting $4,400 by year-end. Major financial institutions share this optimistic outlook. Goldman Sachs has established a base price target of $3,700 per ounce by year-end, rising to $4,000 by mid-2026. In recessionary scenarios, the bank anticipates accelerated investor inflows could drive prices to $3,880 by year-end. Most notably, Goldman considers $4,500 by end 2025 plausible under extreme conditions involving Federal Reserve independence concerns or shifts in U.S. Reserve policy. Supporting these bullish projections is sustained central bank demand. According to the World Gold Council's latest statistics, central banks reported 22 tons of net purchases in June through IMF and public data sources. Krishan Gopaul, senior analyst at the World Gold Council, noted that demand saw a modest month-over-month increase for the third consecutive month, capping a strong first half of the year. Macleod frames this central bank activity in geopolitical terms, describing gold's current performance as inherently political. He observes that central banks have been accumulating gold while effectively selling dollars, exchanging what he characterizes as fiat currency for real money. This video explores the upward momentum in gold prices, the bullish outlook driving further gains, and the weakening of fiat currencies that continue to support gold's strength. Subscribe for weekly, data-driven insights that underpin our ongoing market analysis.
I think Powell is in a very difficult position. Obviously, the jobs report that came out, it's slightly ironic that it's the one thing, perhaps, which Trump would have wanted to persuade Powell that he should cut rates, and he goes and sacks the chief statistician. Talk about shooting the messenger. It's, this is crazy, absolutely crazy. But it is essentially become very, very political. I think if I was in Powell's shoes, I would be worried about signs of inflation. If you look at what's been happening to metal prices, oil prices, agricultural prices, they're not going lower. If anything, they're tending to drift higher, measured in dollars. And that is even before there's any real impact from all this messing around with tariffs. And I just think that, if I was in Powell's position, I would not cut interest rates. But I think those job figures actually makes that policy almost untenable. Again, if I was in his shoes, I'd probably go a quarter-point cut. And then in the script, if you like, the post-cut FOMC script, I would express all my concerns about inflation and all the rest of it, and just get the message over that it's okay, it's a quarter point now, but that's it for the foreseeable future. So I think that's what we're going to get. As to how gold is behaving, I think, Kai, we have to appreciate, we're in this sort of summer lull. I mean, people are on the beaches or they're with their kids who are on holiday or whatever. This always happens, actually, every summer. And talking to other, sort of friends, if you like, in the Substack community, they tell me that, things quieten down in the summer, which I think actually says it all. So nobody's really sitting there and thinking too hard about the implications of what's going on. I guess that in the coming weeks, I mean, particularly in early September, this is what usually happens. In early September, people return from their holidays, investment managers begin to have the committee meetings and all the rest of it. And, the investment strategists in these big firms, start considering the position seriously. And then you find that investment decisions begin to be taken. Ahead of that, I would expect to see things begin to discount what's likely to happen, if you like, in that sense. And on that basis, I would expect gold to move higher. I don't think I would tie gold in too closely with the interest rate story, other than a cut in interest rates is obviously good for gold because it undermines the pricing power of the dollar. Because what we're looking at is not gold going up so much, we're looking at the dollar going down. And there's no doubt, if you look at the dollar's trade weighted index on the chart, it's a pretty bearish scene. So I think it's really how the dollar behaves, if you like, over this, that's going to determine the outlook for gold. And as far as the investment strategists are concerned, when they start to look at this, worries of stagflation, I think, are going to mount and mount and mount. And, so in other words, you're going to get the job losses. I mean, we've known, for goodness sake, we've known that the US economy is not growing. I mean, if you take out the budget deficit out of GDP, you end up with the private sector, plus obviously government spending, but funded government spending actually contracting. And it's been like that for the last couple of years. So there's no way the US economy has been growing. And I just don't see that changing. We've got no growth, in fact, negative growth, if you like, in terms of the private sector, taking that deficit, the budget deficit out of it. No, I mean, so it's a very distorted picture. I see no reason at all why you should not get out of credit and get into real money, which is gold. And I think people will increasingly take that view over the rest of the year. Yeah, well, it is obviously geopolitical because if nothing else, central banks have been accumulating it. They have, in effect, they've been selling dollars and getting into real money. So, yeah, it is geopolitical. We know, at least I know, we don't have, official confirmation, but I think it's generally accepted that the Chinese and also the Russians have a lot more gold than they say they have. They can go onto a gold standard to protect their own currencies from the end of the fiat currency era. So, yeah, I mean, I think this is the background for gold. I mean, looking at it, gold has risen more than quite a lot of the things that you would expect to rise over time with it. I did an analysis a little while ago of pricing base metals in gold, and I found that from the prices in the year 1900, so we're going back 125 years, gold is now less than 20%, sorry, not gold, base metals, a basket of base metals is now less than 20% of the values at that time. Now, the reason I say this is that we do know over long periods of time that the purchasing power of gold is stable. So in other words, while we can't say that, an 80% discount, if you like, in terms of value is an accurate measure of anything, what we can say is that gold is ahead of the game relative to precious metals, and I suspect that's also the case with other commodities. I think this tells us two things. It tells us that a lot of commodities have been left, and I would expect to see commodity prices measured in fiat currencies and also gold tending to rise over the next 4 or 5 years. So I think that's the first implication. The second implication is that gold itself, in terms of its own value, may well be getting a little bit ahead of the commodity game. So it's not just commodities being undervalued, but perhaps gold being slightly overvalued. I would expect to see that measured in fiat currencies. So yes, gold, I think, is a little bit ahead of the game, if you like. But then it is, in terms of its value relative to fiat currencies, it's bound to reflect the prospects for fiat currencies. So I think it's quite reasonable to suggest that the current level is fine in that context. And maybe if things, negative things materialize on the economic and political and geopolitical fronts, then gold is still underpriced. And the interesting thing is, if you look at the technical position in the market, we're just completing what Edwards and McGee, the people who wrote the definitive work on Dow theory all those years ago, call a pennant. And the point about a pennant is that the move in gives you a forecast for the move out once you break out on the upside of the pennant. And so we're looking at adding probably a minimum of $900 once gold breaks 3,440, which is not too far above the current level. Once it breaks up above that, we could run another $900 to 4,400-ish, let's say, in a similar space of time that the move in took, which takes us to that level at the end of this year. So given the technical situation, I think this indicates that there is going to be a developing problem in fiat currencies. And I can see exactly what that is. The asset bubble popping.
China's continued expansion of its gold reserves is drawing attention from analysts who see broader implications for global monetary policy and market stability. The People's Bank of China increased its gold holdings by 60,000 ounces to 73.96 million ounces last month, raising the total value of China's gold reserves by approximately $1 billion to $244 billion, according to data from the State Administration of Foreign Exchange. This accumulation represents more than just portfolio diversification. Analysts suggest China may continue building its official gold reserves to enhance financial security, participating in a broader trend among central banks worldwide to diversify away from traditional reserve holdings. Alasdair Macleod of Macleod Finance sees even more significant implications in China's gold strategy. He suggests that such moves could drive fiat currencies lower and represent steps toward backing a currency with gold. Macleod believes China and Russia could potentially make such an announcement, with Russia possibly delaying at China's urging. He views a potential Chinese declaration as the first step toward what he calls an unavoidable monetary reckoning. Simultaneously, U.S. financial markets show signs of potential instability that could accelerate such shifts. Margin loans supporting asset prices, particularly equities, have reached a record $1 trillion according to Macleod's analysis. FINRA data confirms that investor margin account debt balances hit this milestone in June, drawing comparisons to the speculative environment of 1999. The combination of record margin debt supporting inflated asset prices and major powers like China systematically accumulating gold reserves suggests a potential convergence of financial instability and monetary policy shifts. Let's get back to the interview.
If you look at the margin loans in the system supporting financial asset prices and particularly stock market prices, that's gone over $1 trillion now. That is at an all-time record. So, I mean, this is a bubble which, when it pops, is going to create an awful lot of collateral damage. And what does the Fed do in that case, the Fed and the Treasury? Well, basically, they start rescuing zombies. And maybe, if only to protect the banking system. So, with that sort of trouble in store, I can see gold going up to $4,500 quite easily by the end of this year. But I mean, it is reliant on those things developing. But, any financial historian can see the prospects of that developing if they really look for it. And again, I go back to 1929, credit bubble plus Smoot-Hawley Tariff Act, Mark II this time. And, this Trump's tariffs are even more destabilizing than Smoot-Hawley was by a long chalk. Well, it would drive it without a doubt. It would drive fiat currencies down. Let's put it that way. The purpose of making an announcement such as that, I would have thought, is a precursor to protecting the currency by putting it on a gold standard. They can do it. Of that, I feel quite confident. The Russians can do too, and I'm sure the Russians have already considered doing this. But the Chinese have probably encouraged Putin to stay his hand on this issue. So, it's a situation really where so long as governments and central banks can print money, ad infinitum, then they're going to continue to do it until they have to face the reality. So China making that announcement, I think, would be the first step towards a reality. But I mean, they're moving in that direction already, because the Shanghai Gold Exchange is opening vaults in Hong Kong and also Saudi Arabia. And I'm sure there will be other vaults, around, particularly around the Far Eastern region. I mean, I would expect to see them in Thailand. I would expect to see them in Indonesia, Malaysia, maybe Singapore as well. That region is going to go on a gold standard, I think, without a doubt. It's just a question of when. It's all part of protecting yourself from the follies of the West, and particularly the aggressive follies of America, which weaponized its dollars. I think that's the way it's going to go, because the story at the moment, as far as BRICS is concerned, and also the Shanghai Cooperation Organization, is that settlement will be occurring in their own currencies. Now, I think that their own currencies, it's a question of individual trade agreements. If you're importing, say, copper from Indonesia into China, that's easy enough. You take Chinese yuan. But if you're selling copper into Pakistan, do you want to take their currency? I think the answer is probably you would agree to take Chinese yuan. So I think that's the way it's going to work. And then, having effectively rejected the weaker fiat currencies, I think what then happens is that the yuan becomes, if you like, the replacement for the dollar, and they will need to secure the purchasing power of the yuan in order for it to replace the dollar. But they're not going to do that before they really have to, because to do that before they really have to, I mean, that could end up, particularly with this administration in America, it could end up World War III easily, because it's so destructive of America. Well, I mean, the markets are bemused. I think as far as the Chinese are concerned, they know that they can't rely on America. They know that Trump says one thing one day and another thing the next day. So the idea that the deadline and forget it. I mean, as far as the Chinese are concerned, this is just a whole load of nonsense. And so they're planning to go ahead without America. And they can. They've got the Shanghai Cooperation Organization, which basically is the majority of Asia. They've also got the ASEAN partners, all around them in that part of Asia, the sort of Thailand and Malaysia and Indonesia and all the rest of it, all those nations, which have big Chinese diaspora and therefore are sympathetic to trading relations. They will also, in my view, bring in South Korea and also Japan. And on top of that, you've got the existing members of BRICS, and you've got, what's called the Global South, the ones who at the moment are frightened of America, but want to join BRICS as soon as they see American power diminish a bit. I mean, the world is splitting into two. And we, as American allies, are in the minority. And here we are trying to push the majority around. What happens is they say, well, we don't need you. And I think that is what's going to happen. So, I mean, this is another thing. Once markets begin to realize this, then, capital reallocation, the reallocation of global capital is going to become a major issue for America. In the past, they've dealt with this. And in the case of China, they dealt with this by, if you like, calling them out as being, ruthless against Uyghurs and all this sort of stuff. And they tried, according to one of the heads of intelligence, of army intelligence in China, and this is publicly reported, they reckon that the Americans were behind the 2014 Hong Kong student riots. Why? They've been trying to destabilize China. I mean, attacking Huawei was another, quite simple American operation. Every time the Americans try and do something, I mean, I have this image of President Xi, who doesn't give anything away. He just sort of stands there, smiles slightly like that, and lets the Americans make all the mistakes. It's Sun Tzu, if you like. This guy knows what he's doing, and you have Trump running around like a stampeding herd of elephants in the global economy, thinking that he's doing good for America. No, he's not. He's killing America.
Gold's return to the center of the monetary system would mark a decisive break from reliance on fiat currencies, accelerating the global move toward monetary structures anchored in tangible value. Such a framework could strengthen confidence in national currencies, guard against debasement, and attract capital seeking long-term stability. Such a transformation could bolster confidence in national currencies, safeguard purchasing power against persistent debasement, and attract investment capital seeking security in uncertain times. Beyond monetary stability, this move would likely trigger far-reaching changes in global trade patterns, foster deeper financial integration across regions adopting gold-linked frameworks, and gradually diminish the dollar's dominance in international settlements. Stay tuned for more data-driven insights into the evolving financial landscape. If you value grounded, fact-based analysis, hit like and subscribe so you never miss our weekly updates. Thank you for your support and enjoy the video.